Hello and welcome to my channel, Accounting with Sandra. My name is Sandra and I'm an accountant and lecturer, and I'm hoping to help students and those with a keen interest in accounting and taxation to understand accounting and taxation concepts with videos in 5 minutes and under. In this video, I will explain and clarify the concept of going concern from an accounting perspective. What does it mean by the term going concern, and what happens when an entity is no longer considered a going concern? So let's begin. What does it mean to be a going concern? While there is no specific definition of what it means to be a going concern, it is a key accounting concept. It essentially means that the directors and those charged with governance consider that the entity can and will continue to operate into the foreseeable future. Within paragraph 25 of AASB 101, the accounting standard pertaining to the presentation of financial statements, management are required to assess an entity's ability to continue as a going concern when preparing their financial statements, implying that this assessment must be undertaken on a yearly basis. This assessment is vital as it has significant implications not only on the presentation of the financial statements, but also impacts the applicability of a variety of accounting standards and disclosure requirements. Additionally, paragraph 25 goes on further to state that an entity shall prepare financial statements on a going concern basis unless management either intends to liquidate the entity, in other words, management has decided to sell off all of their assets and clear out their liabilities, or to cease trading, or has no realistic alternative but to do so. Where management is aware in making its assessment of material uncertainties that may cast significant doubt on the entity's ability to continue as a going concern, the entity shall disclose those uncertainties in the financial statements. Where an entity does not prepare the financial statements on a going concern basis, it must also disclose that fact, together with the basis upon which it has prepared the financial statements and the reason why the entity is not regarded as a going concern. In determining whether the going concern assumption is applicable, paragraph 26 of AASB 101 provides us with some factors for management to consider when assessing whether the going concern assumption is indeed appropriate. In undertaking this assessment, management are required to consider all available information about the future, which is at least, but not limited to, 12 months from the end of the reporting period. When an entity has a history of profitable operations and ready access to financial resources, the entity may reach a conclusion that the going concern basis of accounting is appropriate without detailed analysis. In other cases, management may need to consider a wide range of factors relating to current and expected profitability, debt repayment schedules, and potential sources of replacement financing before it can satisfy itself that the going concern basis is indeed appropriate. Now that we have explained the concept of going concern, let's work through this table together to understand the ramifications of management's assessment. In scenario 1, management have not identified any significant doubts about going concern. So for example, they've got ample cash in bank, ample debtors, net cash operating inflows, and are very profitable. In this case, the financial statements can be prepared on a going concern basis and no additional disclosures pertaining to the going concern assumption are required. In scenarios 2 and 3, management have begun to identify significant doubts about the applicability of the going concern assumption. So for example, there are some negative market conditions, a new highly successful competitor has entered into the market, or a non-compliance with a law has resulted in a large penalty. Although these doubts have been identified, management have plans in place to mitigate and manage these risks. As such, they will continue to prepare their financials on a going concern basis, but they will now be required to disclose that there are some uncertainties and how they are intending to manage them. In scenario 4, management can no longer apply the going concern assumption. In this case, management may have decided to sell the business or to liquidate, or the entity may have become insolvent. In this case, the going concern assumption is no longer applicable and the financials need to be prepared on an alternative basis. Although this alternative basis is not specifically defined or prescribed in the accounting standards, the liquidation basis is generally applied. Alongside the liquidation basis, significant disclosure is required to be made to inform the users about the conclusion reached regarding the going concern assumption no longer being applicable and the reasons for this conclusion. On screen is an example of an audited balance sheet for E-Business Systems Limited, which was prepared on a liquidation basis. As you can see, there are no longer any non-current assets or non-current liabilities. Why? Because the entity is not going to continue operating beyond the next 12 months. Remember from SAC 4 that for an item to be considered non-current, it is because the benefits expected or the obligation is due in greater than 12 months. Besides the balance sheet is a snip of some of the policy note disclosure in which management have explained why the going concern assumption is no longer applicable and why the financials have been prepared on a liquidation basis and the implications of their conclusion. I hope this short video has helped to clarify the concept of going concern.